Hemal Shah has 15 years of experience in audit. He is a director with SRBC and Company, a member firm of EY. He has experience on working on few of large multinational and few large Indian promoter companies. He has extensive experience of working on Indian GAAP and Indies. So with this brief description about sir, I would like ask Mr. Sharma to please hand over a memento and to start with this session.
Sir, thank you and all the best. Thank you. Good afternoon all. First of all, let me thank the Chamber of Tax Consultants for giving this opportunity to present my views on Ind AS 116 lease accounting, which is applicable in this year 2019-20 being the first year. I thank all of you who have joined in today's webinar. This is very important considering a very strict deadline all of you would be having on account of tax audit and multiple assignment otherwise also. Okay, so let me first give you the background as to what is Ind AS 116 all about, and then we'll delve into different aspects of Ind AS 116. Historically, lease standard was already there around the world, in India, in Europe, as well as in the US. But a strong need was felt to introduce a new standard on this subject, mainly because of two things. Investors as well as regulators felt that there are long-term commitments being made between the lessor and the lessee, but those commitments are not reflected in the financial statement. So those are enforceable commitments, there are non-cancelable periods, but this completely remain off the balance sheet. They do not come in the balance sheet. So that was one of the major reasons to have this accounted in the books as and when those commitments are taken place. So that was the main reason. Second reason was comparability. So if company buys an asset and if the company leases the same asset, the accounting were completely different. Whereas the objective is to basically make those companies comparable, and hence this standard will help in reducing those differences. With this, let me start the presentation on 116. Content. So what we are going to cover today is overview and scope, effective date transition, how the lessee's accounting will change, because it is the lessee who is going to be impacted majorly by this revised standard. Few of the other concepts which are relevant and which are already given in the standard, few presentation and disclosure requirement which are important one, and otherwise the consideration which are really important and I want you to go through. Coming to slide number 4. The entire concept of lease is now changing. So what is changing? Ind AS 116, as we said, is applicable from April 1, 2019. Now, as far as lessor is concerned, the accounting of lessor is not changing. The lessor accounting remains as it is. So the lessor will see whether it is a finance lease or an operating lease based on the criteria given in the standard. And those criteria are almost same which were there in the earlier standard. So if the economic life of the underlying asset, if the majority of the economic life of the underlying asset is covered by the agreement period, then it is the finance lease. Or if the discounted cash flow during the lease period is more or less equal to the fair value of the asset currently, then it is a finance lease. Or if the lessee has a right to buy the asset at the term of the contract, then it is a finance lease. So all these criteria remain as it is as far as the lessor is concerned. As far as lessor is concerned, again, there is no change in the accounting. However, for lessee, the accounting has undergone a complete change. So lessee till now are recognizing rent expenses in profit and loss account. Now uh, accounting will change in terms of obligation for future lease payment as well as corresponding item of property plant equipment will be recorded. So there will be bloating effect on the balance sheet. On one hand, you will record the liability for the future lease payments you have considered or you have obliged to you have undertaken under the agreement, and those lease payment will be discounted and the current present value will be arrived to reflect in the balance sheet. And the similar corresponding adjustment will be done on property plant equipment side under fixed assets. It is called right of use. So technically, this is not your legal asset. Legally, the owner remains lessor, but since you have a right, it is called right of use or ROU. I will be frequently using the term ROU just for the knowledge. Whenever I refer term ROU, it means right of use. What does it mean? For the lessor and lessee, does it mean the same asset will get capitalized twice? The answer is yes. The legal owner, who is the lessor, will account this as a part of property plant equipment. For example, if it is a plant and machinery, the lessor would be accounting this in its financial statement as a plant and machinery item, whereas a lessee in this case will record this again in fixed asset, but not at plant and machinery directly, but as ROU plant and machinery. So it will be a separate classification, but in the broader category of property plant equipment only. Let's go to the next slide. So on the left side, what you see was earlier Ind AS 17, and on the right side, the last column is how the presentation is changing under Ind AS 116. Under Ind AS 17 scenario, there were classification in terms of finance lease and operating lease. Now, if it was a finance lease, lessee will account an asset and also a corresponding financial liability in terms of what is payable to the lessor, and it will record depreciation and finance cost in its financial. However, if it was operating lease, this arrangement, even though it is long term, will remain out of the books. It will be completely out of the book. Whereas in the P&L, it will be only one expense, lease expense account. Now, when we move to Ind AS 116, finance lease and operating lease models are no longer existing. So there is only one model, which is lease model. There is no further bifurcation between operating and finance. What does it mean? That all the operating lease also will come in the balance sheet. It will be reflected in assets and liabilities, and the rent will be bifurcated into two expenses. One is depreciation on ROU asset, and second, interest expense, which will unwind and which will make the net present value to the actual liability. So those two will be the differences. Now, what does it mean and how the financials will change? So as far as revenue is concerned, there is no change at all. Revenue number will not be impacted. But if you look at EBITDA, EBIT, definitely EBITDA and EBIT will show significant improvement if the company is affected majorly by lease transaction, because the rent expense will go off, from the profit and loss, and the rent expense is getting classified separately into interest and in depreciation. Because of this, EBITDA will definitely improve. Net profit over a period of time will remain more or less same. However, in initial period, the net profit will dip. This is because initial years the interest liability would be huge. Now, this is assuming the company is following straight line method of depreciation. So if the company is following written down value of method of depreciation, then the impact could be much higher. But assuming that the SLM is followed by the company, then also in initial year, interest expense would be much higher, because the outstanding principal amount of the liability would be much significant in terms of value. And every year, when the lessee makes the payment to the lessor, part of that payment goes for interest obligation, but the majority part of the obligation goes for principal repayment. and hence interest payment towards outstanding financial liability over a period of time will go down, resulting into lower interest expense in future years. We move to slide number 6 now. So as we said, in terms of profit and loss, EBITDA and total assets and gearing ratio will definitely improve. However, if you look at the financials, EPS in initial year will go down, mainly because profit is going down. Net assets will, in terms of assets, will go down, and asset turnover and interest coverage ratio also will go down, because since your asset base has increased, turnover remaining same, asset turnover ratio also will go down. Coming to the next slide on recognition and measurement. Now, how does the assets and liabilities will be measured in terms of Ind AS 116? In the first year, when what we call as initial recognition. So either when the transaction is happening for the first time, when you are entering into a new lease arrangement, or in case of transition to Ind AS 116, whichever is earlier, which is called initial recognition, ROU, right of use, will be measured in terms of present value of future lease payment. So, for example, if you are entering into a transaction for taking a property, or say for example a store, for a period of 5 years at say an annual rent of rupees 1000 rupees you are going to pay over a period of 5 years. So total payment is say 5,000. Now 5,000 rupees, assuming the rate of interest is 6%, that 5,000 rupees will be discounted at 6%, and you will work out the net present value as of current date. Suppose that amount comes to 4,212. 4,212 will be recorded first as ROU, right of use debit, to financial liability credit. So both assets will go up and liability will go up. Now, once you record right of use of asset, the same asset 4,212 rupees will be amortized over a period of 5 years equally. If the company follows SLM on an equal installment over a period of 5 years, 4,200 rupees will be amortized over a period of 5 years. Financial liability, on the other hand, will be added by the interest rate. So 4,212 rupees, you will apply 6% interest rate. To that extent, your interest liability, financial liability will go up, and to the extent of payment made to the lessor, you will increase the liability. So each time you increase the financial liability by adding the interest amount, and you will reduce the liability by actual payment, by actual cash outflow. The remainder would be the balance sheet item, which will be reflected in the balance sheet. Now, in terms of ROU measurement, it's not only cost model, revaluation model is also allowed. So the accounting will be done as in Ind AS 16. If the company is following cost model, the cost model will continue. If the company is following revaluation model as per Ind AS 16, the revaluation model also can be applied. As far as depreciation is concerned, the depreciation would be lower of economic life of the underlying asset or the lease period. So if the lease period is 10 years and the economic life of the underlying asset is say 12 years, you will go by 10 years, because as far as the contract is concerned, the contract gives you right to operate the asset only for 10 years. So economic life of 12 years otherwise is irrelevant for you. Now, other way around, if you think that though the agreement is for 12 years, but the underlying asset will be usable only for 10 years, then you should amortize over a period of 10 years. I would also like to highlight the last line, which is in the box. Where do you present leases lease obligation, whether it is a borrowing or financial liability? Now, the standard again is consistent with IFRS 16, so there is no major change except for 1 or 2 tweaks where fair valuation is not allowed under the Indian GAAP. Similarly, those changes are made, but otherwise more or less the guidance under Ind AS 116 is similar to IFRS. Now, the requirement to show this financial liability or lease obligation is into financial liability. However, the Schedule 3 under the Companies Act says for a financial lease obligation, the lease obligation will be shown as a part of borrowing. It doesn't talk about the financial obligation arising out of operating lease obligation. Now there are two views possible here. The first view is the requirement under the Companies Act as per the Schedule 3 format is to show the borrowing financial obligation for a finance lease. Now since there are no model under Ind AS 116 as financial lease and operating lease, that particular requirement is no longer existing, and hence this financial obligation towards lessor may not be shown under borrowing. That is one view. Second view is, when the Schedule 3 was made, that time there was only finance lease obligation which was existing. There was no operating lease model at all. Because operating leases, the companies used to write off on a yearly basis. So since there were no disclosure required separately for operating lease, hence this requirement was no longer there, and the same logic of financial lease obligation now should be extended or should be construed to mean that this will also apply to Ind AS 116. As of now, there is a lot of debate going on, among the institute and otherwise also, how to conclude on this aspect. Most likely, we believe that this will be concluded as a part of borrowing. However, pending this clarification, it is advisable that this amount is reflected as other liability separately on the face of it as a financial lease obligation. Sorry. Now, when I say initial recognition of right of use is recorded at net present value of lease payment. It is also adjusted for initial indirect cost minus lease incentive received. What is initial indirect cost? So initial indirect cost will cover in the next slide, but in terms of restoration cost also, let me spend few minutes here and then take you to the next slide. Under the Ind AS 16, there is a requirement that if there are restoration liability or if there are any obligation towards restoration, dismantling, then those liabilities should be accounted and corresponding adjustment should be made in the property, plant, equipment value. Now, under the IFRS 16 or Ind AS 116 also, there is a paragraph which says if there are any adjustments required for company or for a lessee to provide for dismantling cost or for site restoration, similar liabilities would be provided on an estimated basis on day one, of course by discounting the value of obligation, and the corresponding adjustment will be made to the ROU asset. So to that extent, ROU asset will go up. What does it mean? So previously, the companies would have capitalized this as a part of Ind AS 16 and would have taken to the carrying value of leasehold improvement. For example, if a store is taken on rent, now if the store is taken for 10 years, the agreement between the lessor and the lessee would provide for after 10-year completion, the store will be given back to the lessor in the similar condition as it was given in year 0. So that means the entire furniture fixture done by the lessee will be removed, the balancing, the plastering will be done, and then the possession will be given back to the lessor. This dismantling and again making the process smooth or restoration would involve some kind of expenditure. Those expenditure are to be booked under Indian GAAP also now based on the amendment. But only thing is, till now, since there was no Ind AS 116, the companies would have taken this expenditure as a part of capitalized expenditure of leasehold improvement. Going forward, all this expenditure would form part of Ind AS 116 and will be added to the value of ROU. Second question is on initial direct cost. Let's go to the next slide. What is initial direct cost? Initial direct costs are the costs which are closely related to the lease, or in other words, these are incremental cost of obtaining a lease, which otherwise would not have been incurred if the lease was not obtained. What are the examples? Examples are brokerage and commission for obtaining the lease. So if the company incurs any expenditure very specifically for obtaining a lease, then it is an initial direct cost which is linked to the lease. However, there are few costs which are period costs. So even though these are incremental, but these are not directly related to the lease agreement. For example, diligence cost. Before you enter into any agreement for lease, you might do some diligence. So for example, if a company is opening a store in say Churchgate area, they will go do the checking of vicinity. They will appoint some consultant to understand what is the demand for particular product, what kind of customer, what is the customer profile. Those diligence costs, even though those are linked to opening a store, these are avoidable costs. The store can be opened without this diligence cost also, and hence it is not an incremental cost and can be considered as initial direct cost. This cost should be written off immediately when incurred and not to be added in the cost of ROU. Okay. Going back to slide 9, the standard gives scope exclusion. So there are a few transactions which are not covered by the standard. Lease to explore oil, natural gas, or similar resources. Those natural resources, there is a separate standard. So those are excluded from the scope of Ind AS 116. Leases of biological assets. For lease of biological asset, again there is a separate standard, Ind AS 41, and hence this standard is not applicable. Service concession agreement, these are toll manufacturing arrangement. Again here Ind AS 115 is applicable, and hence Ind AS 116 will not be applicable. License of intellectual property granted by the lessor and rights held by lessee under certain licensing agreement. Here again intangible standard would be applicable, and hence Ind AS 116 will not be applicable. But apart from this scope exclusion, the standard would be applicable to all the transaction. Apart from this scope exclusion, the standard also gives a benefit in terms of not applying the standard, considering the cost and economic benefit. What are those two exemptions? These two exemptions are a choice available with the company. If the company wants to avail the benefit, it can. And if the company does not want to avail the benefit, again it is a choice of the company. These two benefits are short-term lease and lease of. Discuss this into next slides as to what are short-term lease and what are the low-value assets. But just to emphasize here, though both are the options available, there is a slight difference between both the exemption. The first exemption of short-term lease is available by class of asset. What do we mean by class of asset? For example, plant and machinery could be regarded as one class of asset. Furniture fixture can be regarded as another class of asset. If you make a choice of applying short-term lease for a particular plant and machinery, then the same choice would have to be applied for all the plant and machinery. Whereas lease of low-value asset, that exemption is available for individual each and every lease. So if you want to apply this exemption for one lease, and if you don't want to apply exemption for the second lease, even within the same class of asset, that option is available. Now let's go back to what are those two exemptions in detail. First is short-term lease. The standard says short-term lease is a lease where period of lease is less than 12 years. If the period of lease is less than 12 years, the basic premise is, since the entire payment will be made within 12 months, the discounting impact would be minimal, and hence the finance cost either would be minimal or in terms of overall expense it would be negligible, and hence for ease of accounting the standard has given this exemption that you may not apply the lease standard for this kind of short-term lease. Now as we discussed, this is available for the entire class of underlying asset and not to individual leases. If a lease contains a purchase option, then this exemption cannot be availed. For example, uh, you know, there is a period given under the lease for 9 months, but after 9 months, the party has, I mean, the legal property or the legal title of the goods of the underlying property will be passed on to the lessee. In that case, this exemption cannot be availed. And what is the period? When we say period of 12 months and less, what does it mean? Is it only non-cancelable period, or is it the entire agreement period? The period to be considered should be only non-cancelable period. However, if there is a period available after that, and if it is expected that the lessee will exercise that option, then even that period will be considered. So it again depends upon the scenario. So for example, there is a 9 months lease given, which is non-cancelable period, and after that 4 months extra is also specified in the agreement, but that extension is at the option of the lessee. Then you will see what is the intention of the lessee. If the lessee is going to renew, then it is not a short-term lease, because then the underlying period will be 9 months and 4 months, 13 months, and hence the exemption would not be available. Now, interestingly, ITFG Bulletin 21 was issued last week, and ITFG 21 covers many of the questions regarding 116. One question which was put up in front of ITFG was, every year the lessor and the lessee enters into a lease transaction for 12 months, and every year after the 12-month period, it is renewed. It is expected that the agreement will be renewed in future also. Can we consider the past trend, and can we say that the lease in this scenario is not a short-term lease, but it is a long-term lease? The answer here is, you don't go by the past practice. You go by what is written in the contract. If the contract is only for 1 year, then that short-term lease exemption rule is available. Then the period is only 1 year. Past practice is not relevant for this consideration. Going to the next slide on leases of low value assets. Again, this exemption is available for the companies, again for the ease of accounting. If the underlying assets are low value, then the standard setters also felt that there is no point of taking so much effort and doing this entire exercise where the accounting impact would not be significant. But the question arises as to what is low value. The standard does not define in terms of monetary value what is low value. In IFRS also, in the discussion, IASB had decided that $5,000 US dollar, which is approximately 6 lakhs or 7 lakh of rupees, should be considered as a low value item. Now, Ind AS 116 also does not give any monetary limit, but it gives lot of guidance as to what kind of assets will be considered as low value and what kind of assets will not be considered as low value. The whole objective is very small items which are in the nature of small IT equipments, laptops, mobile phones, printers will be considered as low value items. The standard itself gives this criteria, as to what kind of assets will be regarded as low value. Standard also gives a guidance that whenever you are buying an old asset, the fair value measurement will be done as if the asset is a new, and you will derive the value. So if you are buying, or if you are taking an asset on a lease when the asset is old, so for example, if a machinery is available with you, but since it is old, it is available at 5 lakh rupees. But if you go in the market and buy the same machinery, it will be costing 20 lakhs. Question is, for considering whether it is a low value, will you consider 5 lakh or will you consider 20 lakh value? The standard says, even though underlying machine in the agreement is old, but for assessment whether it is a low value, you will go and find out what is the market value of a similar asset if the asset was new, and hence low value exemption in this case will not be available if the fair value of a new asset is higher than the threshold generally applied. Standard also says if the lease is given further by the lessee to another new lessee and then it becomes a sublease, then this low value exemption cannot be availed. Going to the next slide. Now, this is the flow chart or decision tree making given by the standard in terms of how to determine what is lease. So for lease, for any transaction, whether to determine whether it is lease or not, you go through this decision tree. This is also given in the standard in paragraph B31. The entire standard Ind AS 116 is divided into three main buckets. The first is the entire standard, the actual standard. Then the second division is on the application guidance, which is all this paragraph starting with B, and C section is basically deals with all the provision relating to transition. Now, paragraph B31 of the standard, gives this decision tree on how to determine whether an arrangement or agreement contains a lease. So you start with the first point: is there an identified asset? If between lessor and lessee an asset is defined, is identified, then you go further. But if the asset is not identified, then there is no lease. So if I enter into a contract with a supplier for supply of goods without specifying which machine to be used, then it is not a lease. But if I specify a machine, then you go further and decide further course of action. Second point, if asset is identified, then you go to the next point, which says whether the customer has substantially all economic benefit from the use of the asset throughout the period of use. So for example, I have specified an asset. So I want a particular cloth from a textile unit, which is I specified from this machinery only. But I am going to buy only 100 units in the entire year, whereas the capacity of that unit to manufacture is say 10,000 units, right? So in that case, if the company is going to manufacture 10,000 units from that machinery, my portion of buying would be not more than 10%. In that case, I am not covering the substantially all the economic benefit, and hence not. Answer is again there is no lease. However, if I am taking most of the economic benefit, then we go to the next step. Now, question would definitely arise as to what does substantial mean? Has it been defined in the standard? Again, no. As we know, Ind AS standards are all based on the principle and not based on the rules. So it will basically give you broad-based principles, and then it will leave on the companies actually to implement in the right spirit. So generally, if the percentages are 80-90%, definitely it is substantial. But if it is like 50-60, then it is not. Now, having decided that the lessee is taking substantially all the economic benefit, then you move to the next step. Does the customer or the supplier who decide on how to direct and for what purpose the asset is used throughout the period of the agreement? So if the asset can be operated, what to manufacture, how to manufacture, of all these decisions, if these are taken by supplier, then again it is not a lease. However, if everything is decided by the customer, the entire maintenance, how to manage, when to run, how much to run, if all those decisions would be taken by the customer, then it is a lease. Most of the transactions would be filtered up to this level. Internet connection is fast. Now, after doing this analysis, the analysis would be clear whether it's a lease or not. However, in some cases, it might happen that this decision on how to operate, when to operate, is not done either by the customer or supplier, but it is done jointly or it's a predetermined. In that case, you need to further analyze as to who actually decides. So in this case you do further analysis, and then we'll go to step number 4. It says, does the customer have the right to operate the asset without supplier having right to change those operating instructions? So if the customer, in this case lessee, can operate the asset the way he wants, then again it is a lease. If it is not, then you go to the next step. Did the customer design the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? Then again it contains a lease. Otherwise it is not a lease. So whenever you come across a transaction, I would request all of you to sit with this particular decision chart, which is already provided in paragraph B31 also in the standard, and a decision can be easily made as to whether it contains lease or not. Okay.
Can we say?
No? There is some technical problem. We'll just take a break for 1 minute and we'll resume. बीच में कुछ आया, कनेक्शन लॉस्ट करके आया था. एंड मीटिंग कर.
ठीक है, चलो
क्वेश्चन कॉपी करो तो कॉपी कर लीजिए.
हाँ, ये तो 6 महीने लगते हैं.
इसी नहीं चल रहा है. आवाज बराबर आवाज ना. ओके, मैंने बेवर मैसेज आ गया तो कि कनेक्शन, हाँ लिंक स्टार्ट कर दिया. अच्छा, ओके ओके ओके. अदरवाइज बीजा कोई कली कोई नहीं, पण के रखो बाय चांस कोई डिस्कनेक्ट થાય તો કે ચેન. ओके ओके करे रिज्यूम. पॉइंट पे आ जाइए जहां पे थे. 1 मिनट 13 पे आना. સ્પીડ બરાબર ને?
Bonus question, the rate of interest.
એક કવ થાય છે પછી.
હા, ક્વેશ્ચન્સ તમને આપી દઉં છું.
ઠીક છે,
સ્લાઇડ
લખીને આપી દેજો.
ચાલુ કરો. स्टार्ट हो गया क्या? चालू कर लो. Okay. After deciding about this decision as to whether the agreement contains lease or not, now let's go to the next slide on definition of lease. So most of these slides are again now flowing from the previous slide, but what I've done is I've broken up the entire family or the decision family tree into small slides to understand it much better. Now, what is lease? So for lease, there has to be an identified asset, and apart from identified asset, there has to be a right to control the use of the identified asset. If anything is missing, then it is not a lease. So in the agreement, you specify that I will be requiring material from item number or machine number A, then it's the identified asset. Then machinery A becomes an identified asset. Apart from that, the lessee also should have right to control the use of identified asset. Then it becomes a lease. Now, going to the next slide, just specifying identified asset in the agreement directly does not mean a lease. If lessor has a right to substitute any other asset with identified asset, then it is not a lease. What does it mean? For example, I have said in an agreement that I want particular output from machine A or machine line number A. Now, machine A is already specified in the agreement and it is identified asset. But supplier has got similar machines, machine B, C, D and E. All machines give the similar output, and even though I have specified that I want production from machine A, but if machine B, C, D and E also gives the similar output, and if the lessor can give me output from any of the machine, then machine A may not become a lease. Go to the next slide. What is, for identification of asset, an underlying asset has to be physically distinct. If the underlying asset is physically distinct, then sorry. Again, the message is coming. Okay.
I can see that.
Fine. If the underlying asset is physically distinct, then definitely it's an identifiable asset. However, in many of the agreement, it may also happen that asset may not be physically distinct, but indirectly the asset could be identifiable asset. When, for example, when the customer has a right to receive substantially the entire capacity of the underlying asset. So, an agreement between lessor and lessee does not specify that you want production from particular item of machine. However, if by virtue of the contract, if you are covering 95% of the capacity of the underlying machine, then it is presumed that because of the major economic benefit flowing to the lessee, that becomes an identifiable asset. Now, in many of the contract, there are protective rights given as per the agreement to the lessor. These protective rights would be in the nature of, the lessee will not use the asset beyond the normal capacity. Now, those are, the measures taken by the lessor to ensure proper safeguard of the asset. Because if the machinery is used by utilizing more than normal capacity, say by utilizing 120% of the production capacity, it can damage the functioning of the machine. Those protective rights cannot be a hindrance in terms of whether it is a lease or not. So those are the protective rights. Otherwise, if all the rights are enjoyed by the lessee, then those protective rights are not to be considered as a hindrance, and hence the lease standard would be applicable. Let's go to the next slide. Where by 3 different examples, the picture would be more clear. In this, customer C enters into a 12-year contract with supplier S for the right to use a fiber optic for data transmission cable between India and US. Again, before I start this example, I want to highlight that Index 116 is applicable not only to normal rent agreement or normal lease agreement, what we generally perceive, but also to embedded lease. So, all the third-party manufacturing assignments or all the tool manufacturing agreements will also be covered, which were, for example, internationally, IFRIC 4 was issued, or in our case, the lease standard also had an appendix to cover this kind of transaction, which were in the nature of lease. So here, customer C has a 12-year contract with supplier S. Now, scenario 1, the customer C says that out of 5 cables, 3 cables will be used exclusively by me. In this case, those 3 cables which are specified, so cable A, B and C are physically distinct, and the entire capacity of cable A, B and C are going to be used by customer C, and hence it is an identified asset, and hence it will be a lease. Scenario 2, where underlying cables are not identified, but it says 60% of the capacity of all the 5 cables will be used by the customer. So again, see the scenario 1 and 2. What is the difference? The difference is, in the first scenario, it is very clearly specified that out of 5 cables, cable A, B and C will be utilized by the customer 100%. Cable 4 and cable 5 will not be utilized. And hence 4 and 5 are completely out of the scope. Cable number A, B and C will become identified asset. In scenario 2, cable A, B, C, D and E, all 5 cables are bundled up in one contract, and instead of taking individual cable, the entire 60% of the capacity is taken by the customer. In this case, it is not an identified asset because first of all, there is underlying asset is not identified in terms of particular cable, and second thing, in overall capacity also, it is not significant capacity which is enjoyed by the customer. When we are saying significant, it is like 80, 85, 90% of the capacity. In the current case, it is only 60% of the capacity which is enjoyed by the customer, and hence it is not an identified asset. Scenario 3, 90% of the cable's capacity is committed by the customer. In this case, yes, since the majority of the underlying capacity is already undertaken by the customer, hence it will be regarded as identified asset. Let's go to the next slide in terms of definition of lease, in terms of how right to control. Now, right to control the identified assets has basically got who decides, who takes the benefit, and who decides on the how and what purpose the asset is used. If the customer decides how to run a machinery, how much time it should run, when to run, if all those decisions are taken by the customer, then it is a lease for the customer. However, it is not, then it is not a lease. Paragraph B26 in the standard gives a lot of guidance in terms of how to determine whether how and what is decided by the customer or by the supplier. Go to the next slide, slide number 18, on definition of a lease, right to control. Now, who takes the how and for what purpose decision? If the decisions are taken by the customer, then from customer's point of view, it is a lease. If all the decision on how and what is made by the supplier, then it does not contain a lease. However, if it is predetermined in the agreement itself, then again further analysis is required. What those analyses are, you need to decide whether the customer has a right to operate the assets overall, and the seller will not put any major conditions other than protective conditions. In that case, it can become a lease. Going to the next slide, lease term. Very important topic to discuss. What is lease term? The entire accounting will change if you don't take the lease term properly. The lease term is basically non-cancelable period. However, it includes the period covered by an option to terminate the lease only if the lessor has the right to terminate the lease. What does it mean? Let's take an example. There is an agreement. Agreement is for 10 years. Now, initial 4 years, the agreement is non-cancelable both by the lessor and the lessee. After 4 years, lessee does not have a choice. Lessee has no choice but to continue, but the lessor has a right to terminate the agreement. Just to repeat, there is a 10-year agreement. Up to 4 years, it is non-cancelable by both the parties. After 4 years, only the lessor has a right to cancel. In this case, the lease term would be 10 years. Because from lessee's point of view, the entire 10 years is a committed period. Even if lessee wants to move out, it cannot move out. After 4 years also, the right to cancel is only with the lessor. Hence, from lessee's point of view, the entire period of 10 years will be considered as a lease term. Then second is period covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. So similar case, suppose if the agreement is for 10 years, 4-year is non-cancelable, but on the 5th year, the lessee has a right to extend it. In that case, it will be lessee's choice. So if lessee is intending to extend it up to 10 years, then it will be regarded as a 10-year period. Now, again, you'll have to consider the reasonable assessment as to whether the company will make the extension or not. What are the criteria? On the right side, there are few bullets given. Those will derive as to whether the lessee would extend this at the end of the 4th year. First is favorable term. So if the rent is fixed and after 4th year, because the rent was committed in year 1 and the 5th year the rent has gone up tremendously, the lessee, from lessee's point of view, it is favorable that he continues, then definitely it is assumed that lessee will continue. Significant leasehold improvement. Now, if the lessee has already invested heavily on leasehold improvement, for example, if the company has opened up a store, for putting the store in a proper condition, the lessee would have invested in furniture, fixture. Now, it always makes sense from the lessee's point of view to continue for a period of 10 years rather than 4 years to cover the value of the investments made in terms of leasehold improvement. If there are significant leasehold improvement made, then definitely the lessee would be intending to continue for a longer period. Termination and relocation cost. At times, the lessee may have a right to come out of the agreement, but it may not do so because, if it does so, it will have to pay high termination cost. That could be a deciding factor whether to consider this extension period or not. Then specialized asset. So for example, if the store is opened up in a premium market. So if you take example of Bombay, Phoenix Mall in Lower Parel is one of the premium mall. Now, if you have opened a store here in Phoenix market, then definitely the lessee would be intending to continue because it's a premium area. In that case, even that factor could be considered. Past practice, interaction with other contract terms, and length of the non-cancelable period. If the length of the non-cancelable period is short, it is always assumed that the lessee will try to continue for the entire period of the agreement. So those are the factors which will determine whether the lessee will continue for the future period or not. And the third, period covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. So there is a period of 10 years. Cancelable period is only 4 years. Non-cancelable period is only 4 years. And at the end of the 4 year, the lessee has a right to terminate. Then again you will decide whether actually lessee will terminate or not. Based on again the criteria what we have seen on the right side. If it is assumed that the lessee will continue, then you will assume that the entire period will be covered by the agreement and you will consider the entire period. Again, just to repeat, lease period is the non-cancelable period, but however, if the lessor only has a right to cancel, then the entire period will be covered, because if the lessor has the right to cancel and lessee does not have a right to cancel, then in that case, from the lessee's point of view, that obligation is always there. The lessee cannot move out of the obligation unless and until the lessor terminates. In that case, you will consider the full period. And if the lessee has the right to cancel, you will go by the intention of the lessee. After spending time, let's spend few minutes on transition approach. Now, in transition approach, as given by the other standards, this standard also gives two approach. One is full retrospective approach, and the second is modified retrospective approach. Now, only difference is in modified retrospective approach also, there are further two options available in case of 116. So what is full retrospective approach? In full retrospective approach, when you apply the standard for the first time, for example, in 2019-20, you restate the previous year number also. So if you're applying in this year 2019-20, you go back and restate 2018-19, and hence 1st April 2018 becomes your starting date for all the calculation. You will measure the liability and also ROU upon the standard as if the lease under which, for which you are making the working, the standard was already there. Based on that, on 1st April 2018, which is the first day of the previous year, you work out what is the liability, financial liability, you work out what is the right of use asset, and the difference is adjusted in revenue. In modified retrospective, the previous year numbers are not restated. The entire adjustment is given on the start of the current year financial statement. So what do? You work out, again, for modified retrospective, there are two methods which are given in paragraph C8C. C8C1 and C8C2. There are two different approaches. Again, the method of working out liability, lease liability, is same. So for lease liability, you see how much payment you have to make on the transition date. So for example, if the contract is for 5 years, 2 years have passed and 3 years are remaining, you will see on 1st April 19, how many years are left, remains which you are going to make in future. You will discount and work out the net present value. That will be your liability, right? So lease liability amount will be same in both the approaches in modified retrospective. However, the measurement of asset changes in both the approach. How do you measure in the first modified retrospective approach? The option says for creating ROU, you work out the ROU balance as if the standard was applicable from day one. So for example, if you had taken the asset in 2015, you work out the ROU 1st April 2015 and then depreciate to arrive at value or WDV on 1st April 19. That will be the WDV of ROU which will be recorded, and the difference between lease liability and ROU will be adjusted in reserve. Whereas the second method says, very simple, whatever lease liability you have calculated, the same balance will be reflected in ROU. Now, just to kind of emphasize here, second approach in modified retrospective, the table on the right side, looks that way easy to implement because it involves less working as compared to first approach in modified retrospective. However, generally the lease liability amount would more or less, in most of the cases, it would be on a higher side, because the interest payments would be high as compared to the subsequent years, and hence if you work out ROU based on the second approach, the ROU balance would be higher. Whereas if you apply first method under modified retrospective, the ROU balance generally would be lower. The benefit to companies is the depreciation as well as majorly the depreciation amount in future year would be lower if you apply method 1 in modified retrospective, even though it requires a lot more calculation in terms of working out the asset and liability value. And second is, if the company is into MAT, definitely the company can think of applying method 2 of modified retrospective, because to that extent your depreciation would be higher in future year, and to that extent you can save on MAT. So these are practical experiences the company will have to think through in terms of what it fits and how does it help in applying the principle. Now, just wanted to highlight few of the things. Full retrospective and modified retrospective, these are the two broad options available to you. However, this option, whether you want to go for full retrospective or modified retrospective, are available for company as a whole. So you cannot make pick and choose. You cannot make your decision with respect to individual lease as far as which method to follow, full retrospective or modified retrospective. However, within modified retrospective, the choice to go for option number 1 or option number 2 is available lease by lease. So there you can pick and choose. There is one more option available if you apply modified retrospective approach. Suppose if the lease agreement is not a short-term lease, say for example, if the original lease is for 5-year period. However, say 4 years are already expired and on transition date only 1 year is remaining. Then it is a short-term lease and the short-term lease exemption can be availed if modified retrospective approach is used. However, if it is a full retrospective approach, then the option of short-term lease is not available based on the remaining life period. So even if the original agreement is for 5 years and on the day of transition only 1 year is left, still you need to apply the entire lease accounting for those kind of transactions. Now, next slide, I'm on slide number 22. Just how do we record the lease liability and ROU? For operating leases, lease liability again would be recorded based on the present value of the remaining lease payments. Only difference is if you are doing full retrospective, then the discount rate what you apply would be the discount rate on the day when the agreement was entered. However, if you are doing modified retrospective, then in modified retrospective, a further exemption is available that instead of arriving and determining the discount rate to be used on the day of agreement, you can straight away go to the rate of discount to be used on the transition date. So if you are applying till 2019 modified retro approach, all your agreements, whether it is those are entered in 2014, 2010, 2018, for all the agreements, you can take just one discount rate to work out all the working for future liabilities and lease liability in ROU, which is the discount rate on the day of transition on 1st April 2019. So the difference between this calculation. Now, as far as what we discussed was about the operating lease. What about the finance lease? So finance lease, the balance will continue from Ind AS 17. So the same balances will carry forward in Ind AS 116. Going to the next slide, let's see a practical scenario as to how does the working will happen. In this case, H company enters into a 5-year lease of equipment. H agrees to make annual payment of ₹1,000 at the end of each year. Transition to Ind AS 116 is in year 3. So for example, on the left side table, you are seeing year 1, 2, 3, 4, 5. Every year, ₹1,000 are paid. Now, 1,000, the discounted value at 6% in the year 1 is 943. In second year, it is 890. Third year value is 840, and so on, which gives you total of 4,212. That becomes net present value of ₹1,000 paid every year at 6%. So 4,212 is the ROU in initial year, in year 1. So if you had applied Ind AS 116 from the beginning, your ROU would have been recorded at 4,212. On the table right side, you will see, on initial recognition, ROU is at 4,212. Once you record ROU of 4,212, you depreciate based on your method. If your method is WDV, you go by WDV. If it's SLM, you go by straight line method. Assuming your method is straight line method, you will divide 4,212 over a period of 5 years, which is 842, and 842 will be depreciated every year, which will bring down the value of ROU every year by 842. So in end of the year 1, the balance is 3370, which is nothing but opening minus column number B, which is depreciation. If you go to column number C, the lease liability, on the day of on the initial recognition, the lease liability would be 4,212. Now, at the end of the 1 year, you will increase this liability by 253 rupees, which is nothing but 6% on 4,212, which gives you 253, which is nothing but interest expense for the entire year. So 4,212, which is the opening balance, add to that 6% interest on 4,212, which is 253 rupees, minus repayment of 1,000. That will give you the closing balance of 3,465. And similarly, year 2, 3, 4, 5, it will continue. At the end, the amount will become 0. Now, in this example, let's assume that company applies the Ind AS 116 in the year 3. So what does it mean? If you are going for full retrospective approach, then year 3, for example, is say 2019-20. If you are going for full retrospective, then year 2, end of year 2, year 2 will become comparative. In full retrospective, year 2 also will be restated. And if it's a modified retrospective, then the entire adjustment will be given in year 3 itself. So let's go to the next slide and see how does it work. So column A talks about full retrospective approach, where ROU of 3370, which is nothing but WDV of ROU at the end of year 2 is recorded. The liability of 3465 is recorded, and the difference between the ROU and liability of 95 is adjusted in retained earning. Now you are restating the previous year, so all these adjustments will be done in 1st April 2018. If you are doing for 2019-20, 18-19 will become comparative, and on 1st April 2018, this 95 rupees will be adjusted in reserve, right? And 842 depreciation will be recorded in 2018-19 balance sheet, and another 842 depreciation will be recorded in 2019-20. Similarly, interest expense of 253 will be recorded in 2018-19 as a comparative, and another 208 will be recorded as interest expense in the current year. If you are going by modified retrospective, then you will see what is the liability at the end of year 2, which is starting of the year 3. In that case, ROU is 2527, liability is 2673. In that case, 146 is the difference, which will be recorded as an adjustment in the opening reserve. You will not change your previous year balance, so there will be no depreciation. P&L will be exactly same. Depreciation of 842 will be recorded in the current year, right? This is for modified retrospective option 1. If you go by modified retrospective option 2, then liability would be same. 2673, the liability would be exactly same, which is in option 1 also. Now here, ROU asset, you don't measure it. ROU asset will be amount which is equal to the liability. So 2673 is the liability, same amount you put in ROU asset, and there is no adjustment in the opening reserve, right? So 2673 now will be amortized over the remaining lease period or remaining economic life of the underlying asset, whichever is lower. Now, if you see what I was speaking earlier, then in both the methods, modified retrospective A and modified retrospective B, modified retrospective A would require a lot more calculation because you need to work out lease liability separately, you need to work out separate working for ROU asset, but overall the depreciation is lower as compared to modified retrospective approach B. Going to the next slide, separating lease component. So in many of the contract, there could be more than one payment, in terms of there could be arrangement of multiple leases, or in some cases, lease could be combined with a service agreement. Now, how do we deal in this kind of scenario? In this, you have to analyze that each lease component is identified separately. So whether in the same agreement there are multiple leases or not. If there are multiple leases and if all the underlying assets are different and it can be used without too much dependence on other, then try to identify all these leases separately and account separately. If there are non-lease component, for example, in case of plant and machinery taken on lease, many times the lessor also gives a maintenance or operating services. In that case, the amount paid is not only for the for taking the plant and machinery on hire, but it is also some amount is paid for the maintenance of the contract or maintenance of the underlying machinery. In that case, you need to segregate maintenance fee separately and account that as a separate expense and not to include that as a part of Ind AS 116 calculation. So if you are paying 1,000 rupees for a contract and that 1,000 rupees gives you both the right to operate the asset, and also the supplier will actually manage the maintenance. In that case, you identify purely maintenance, if you do purely maintenance contract, how much the lessor will charge. If that charge is say 50 rupees, then out of 1,000, you remove 50 and then 950 is considered to be lease payment, which will be considered for Ind AS 116 calculation. The remaining 50 rupees is paid for the annual maintenance, which will be regarded as a normal expense, repair and maintenance, and it will be recorded every year as repair and maintenance expenses. Now, there are 4 steps to determine separate lease component. So you determine what are the lease components, you determine what are the non-lease component, you determine what is the total consideration, and then segregate this consideration into lease component separately and non-lease component separately. How do you segregate the lease consideration in lease payment and non-lease payment? Again, the standard says it is based on the relative fair value of the contract. Okay. Separating lease component, ROU is lease can benefit from ROU either on its own or together with another resources readily available to the lessee. And ROU is neither highly dependent on or highly interrelated with other ROUs. In that case, you consider both the things at one contract and you don't segregate. If the underlying ROU are highly dependent, then you regard the entire lease as single lease. You don't segregate. However, if the benefit can be availed without depending too much on other, then the separate lease component analysis would be critical. Now, going to the next slide, slide number 26. The standard gives the nature of payments under lease into 3 buckets. First is lease component, second is non-lease component, and third is what standard says as a not a component only. So what are those? So for example, lease component, any payment made for utilizing the underlying asset is lease component. Non-lease component is something which is not for the underlying asset, but it is for some services. So maintenance services or supervision services would be considered as a non-lease component. What is not a component? Not a component is where there is no transfer of goods, there is no transfer of service also. These are some kind of obligation which are actually obligation of the lessor, but which lessee undertakes. So typical example would be, say, if you take a rent, if you take a store on a rent or a building on a rent, and you undertake to pay property tax, or if you take a plant and machinery and you undertake to pay insurance on behalf of the lessor, then those obligations are typically the obligation of the lessor. Lessee undertakes those obligations, but in turn, the lessee does not get anything. It does not get any property or underlying asset. It also does not get any services. So those are not a component. What standard says is the consideration has to be split into lease component and non-lease component separately. But consideration paid, which is for not a component, is not covered by the standard. That has to be expensed out immediately. There are practical expedient given in the standard itself. It says generally the allocation of lease components or lease payment should be made for lease component separately and non-lease component separately. For example, if I have taken under an agreement, I have taken a plant and machinery on rental basis, and the contract also makes the lessor liable to give me maintenance services, then I will segregate the consideration into maintenance service separately and for use of the machine separately, and I will account those two as a separate component. So lease payment for machinery I will account as a part of ROU. Maintenance services I will account as and when I incur those expenses, and I will pay to the lessor. However, as a practical expedient, the standard says if the company wants to show the entire amount as a lease payment, then that option is also available. Then the entire amount will be considered as ROU, and you may not segregate between lease component and non-lease component separately. Going to the next slide, slide number 29. It's an example given to understand this concept in a proper way. So in this case, lessee has taken a photocopy machine on lease for a period of 5 years. Lessor also undertakes to provide maintenance services. Lessor obtains its own insurance for Xerox machine. Annual lease rental is rupees 2000, which includes maintenance service of rupees 300 and insurance of rupees 50. Lessee is able to determine that maintenance and insurance services are being offered by the third party at rupees 400 and rupees 50 respectively. Observable standalone price is not available for Xerox machine with maintenance service. Right. Now, how do you do this? So one is fair value of maintenance service is 400. So that itself is a separate lease component. So you segregate 400 rupees separately. As far as insurance is concerned, it is different. It is not a lease payment. It is not a non-lease payment. Whereas as per the standard, it is not a component only. To term something as a non-lease, there has to be a service. So for example, maintenance is a service which the lessee is enjoying. Whereas by paying insurance, the lessee is not benefit, and hence it is not a component at all. So rupees 50 will be altogether disregarded. Rupees 400, which is the fair value of the maintenance services, will be reduced from the overall payment of 2000, and 1600 will be used to consider calculation of ROU. Now, consideration, how to measure a consideration in contract. The standard says there are different components to measure lease payment. First is fixed payment. Whatever payments you are making to lessee are to be considered for the calculation of ROU. Exercise price of a purchase option. If after the termination of the contract, if the agreement provides for lessee to buy, then that exercise price also will be considered in the lease calculation, provided the lessee is reasonably certain to exercise that option. Payment for penalty or terminating the lease. If the lessee is planning to move out of the contract by terminating the lease and penalties would be paid, those penalties also would be considered in the calculation. However, if the lessee wants to continue for the entire term, then these penalties will not be considered for the purpose of calculation. variable lease payments that depend on any index or rate. Now, generally, variable lease rents will not be included. However, if variable lease payments which are dependent on an index or a rate are considered, what are the examples? Examples could be variable lease payment which are linked to LIBOR. So the agreement may say that you will pay me X rupees every year. However, if LIBOR goes beyond 5%, then the amount of rent would be so much. In that case, the lessor and lessee have understood that generally the interest rate considered in the lease agreement is assuming X rate of LIBOR. But if the LIBOR rate moves upward, then definitely the extra charge will be paid by the lessee. In that case, those variable lease payments to the index are always considered as a part of lease payments. However, the lease payments which are not linked to the index, for example, many cases the rent is in the nature of variable payments which are linked to sales. Very prevalent in restaurant industry or quick service restaurant, where payments are linked as a percentage of sales made by the underlying store. So instead of giving a fixed rent, the lessor and lessee will agree that 5% of the sales made from that store will be regarded as rent. In that case, it is a variable lease payment which is not linked to an index. It is linked to the sales. In that case, it will be excluded for the purpose of calculation of ROU. And the last is residual value guarantee. Many a times, the lessor and the lessee agree that after the end of the term, the lessee will guarantee that rupees X will be the fair market value of the underlying asset. The lessor's objective is to ensure that lessee operates the machine in a proper condition and it does not damage the machinery throughout the use, and hence it will give a condition that it will be after the period of the agreement, the item will be sold in the open market, and if the open fair market value by selling in the market is less than the X price, then the lessee undertakes to make the payment. In that case, this residual value guaranteed by the lessee is also included in the calculation of ROU. Okay, next slide, we'll discuss what are the variable lease payments. So as we discussed, variable lease payments which are linked to the index, LIBOR, or some global rate like crude rate, those will be always considered as a part of lease payment. But lease payment which are purely variable, variable in terms of as a percentage of sales or as a percentage of performance, then those are pure variable payments and those are excluded from ROU. So how does the accounting work in those cases? So for example, if there is a commitment that rent will be 5% of sales, in that case, this will not be considered as a part of ROU and the amount will be expensed out as and when the expenditure is incurred. So it will be treated as a normal rent. There might be cases that the contract gives both the condition. It will say rupees 10,000 minimum every year. However, if the sales is beyond X, it will be 1% of X. Then in that case, whatever is the fixed amount, that will be considered to calculate the ROU, and extra amount which is as a percentage of sales, that will be accounted as and when the payments are made. So in that case, there will be dual accounting. One part which is fixed at the time of inception will be considered for the purpose of calculation of ROU, and the second part which is purely variable will be accounted and expensed out as a rent as and when it is incurred. Okay, the next slide talks about the lease term and lease payment, whether in substance, fixed or variable lease payments. So question arises, the variable lease payments have to be genuine. If the variability is genuine, then it is fine. The standard says, then it should be variable and it should not be accounted under 116 as ROU. However, if the lease payments are genuinely variable, even though the probability is high or low, irrespective of that, you disregard for the purpose of calculation. Now, next slide talks about allocating consideration in the contract for the lessee. So, for lessee, the accounting of the contract, when there are multiple consideration, you go by the relative fair value of the individual components. So, whether it's a lease component, then you arrive at the relative values, relative fair values of multiple lease component and allocate the values. If there are lease component and non-lease component, you arrive at the relative fair value of lease component and non-lease component. You total up. You then allocate the rent payment as on the relative fair value and determine the price. As far as lessor is concerned, the lessor will follow the accounting as per 115 and record as per the revenue standard. Now let's see how the presentation and disclosure changes for lessor and lessee. As far as lessee is concerned, the in the balance sheet, the significant amount will now come as part of ROU. Now, where do you show and present ROU? Right of use asset, whether it is a tangible asset or an intangible asset. If you look at the standard, the paragraph 47A1 is very clear. It says the ROU will be accounted separately from other asset. However, it will be clubbed with the underlying nature of asset. So, for example, if you have taken some furniture on rental basis, then where you show furniture, if you show furniture as a property plant equipment, in the same property plant equipment, you will show furniture fixture ROU separately. So, considering this, it is assumed that ROU also would be part of tangible asset. It will not be intangible. Only thing is, you will show separately furniture and separately ROU furniture. Now, there are practical ways to do it. Either you show in the same property plant equipment table underlying asset separately and ROU of that underlying asset separately. For example, plant and machinery, ROU plant and machinery. Furniture fixture, ROU furniture fixture. Other way to present is you have normal property plant equipment schedule and a separate table for ROU property plant equipment schedule. Both approaches are fine. Company can follow as per its own convenience. Apart from that, the income statement also will have disclosure on interest expenses, on variable lease expense, short-term lease expense, and low value asset lease expense. So all these three, whether it is a variable lease expense, short-term lease expense, and low value asset lease expense, will be part of rent expenses, because those three will not be part of ROU, especially when for short-term lease and low value, the exemption has been chosen by the company. In cash flow, there are few disclosure of principal payments within the financing activity, interest payment, lease payment for low value asset, which will be part of operating activity, and some supplemental disclosure also required by the standard. For lease liability, we have already discussed, so I'll not spend time, but as of now, there is a debate going on whether the lease liability in the balance sheet, whether it will be a financial liability or a borrowing. So there are two views as we discussed, but until the clarification is issued by the institute, it is advisable to show this on the face of the balance sheet as a separate line item altogether, and to term this as a lease obligation. From lesser accounting point of view, as far as finance lease is concerned, if the lessor has given an asset in finance under a finance lease, then it will have to de-recognize the underlying asset. So, for example, I have taken an asset and I have given on a finance lease to someone else. I've say for example, for 15-year period, then I will de-recognize property plant equipment and I will recognize only financial asset as loan receivable in my financial. However, if it is an operating lease, then the presentation would be same. I'll continue to show this asset in property plant equipment, and as in when I receive the amount, it will be regarded as rental expenses. Just to reiterate, this finance lease and operating lease, these two models are available only from the lessor's point of view. From the lessee's point of view, there is only single model under 116. Now, few important consideration. If I go to slide number 38, throughout the topic we discussed about discount rate, discounting the cash flow to arrive at ROU. What is the discount rate? What discount rate we should use? So answer to that is very simple. It says, the standard says, whenever the agreement explicitly gives an interest rate or discount rate, use the same discount rate. So if you go and buy machinery, you are given in X price, but if you want to take it on higher, the agreement says that considering 9% interest rate, lease payment would be this. In that case, 9% is a rate which is specified in the agreement, and it is explicitly provided for that kind of arrangement. In that case, you take that rate. However, if the agreement does not give this rate, then you apply incremental borrowing rate of the lessee. So if lessee goes in the market and what rate it can avail the credit facility, that rate would be the discount rate which will be used for discounting the future cash flow. Now, at times there are practical issues. Specifically if the company has no borrowing, then generally companies will say, how do I determine my incremental borrowing rate? Yes, I agree there are practical challenges, but in that case also companies will have to identify what is incremental borrowing rate by going to the bank and by getting quotes from the banks to say, if I borrow currently, looking at my balance sheet, what rate will offer me, and that rate will become incremental borrowing rate and hence the discount rate. Subleases. Now, the standard says, if you are a lessee and you further give this asset to another lessee, then the standard says you cannot apply exemption first of all under short-term lease or under low value asset. In that case, there are two leases. First is the head lease and the second one is the sub leases. So there is no change required as far as the head lease is concerned, provided any exemption is not taken, short-term lease as well as the low value. However, if the exemption was taken earlier for low value or for short-term lease, then you will have to remeasure the ROU if you enter into a sub-lease. Next slide, there is an example. So, an intermediate lessor enters into a 5-year lease for equipment with entity A, which is the head lessor. Useful life of an equipment is 15 years. Now, there are two scenarios. In the first scenario, the lease is starting beginning of year 3. The intermediate lessor subleases the equipment for the remaining 3-year life. So the first lessee has taken the equipment for 5-year lease. 3 years are remaining now, and it enters into a further agreement with another party by subleasing it. So remaining year under original agreement is 3 years. He is entering for another period of 3 years. So basically he is covering the entire life cycle or the entire life of the agreement, and hence it is a finance lease. However, if he does the same agreement again for 3 years, however at the start of the first year only, not in year 3 but in year 1 only, then he is giving a lease only for 3 years, whereas his own lease period is 5 years, and hence it can become operating lease, because then in that case the sublease period covers only 3 years out of the main lease period, which is of 5 years. So it is not substantial, and hence then it becomes an operating lease. Now, the standard I'm going to the next slide on sale and leaseback transaction. The standard gives a very beautiful guidance on sale and leaseback transaction. This practice is prevalent in many industry, especially in airline industry, where airlines used to buy the aircraft from the manufacturer like Boeing or Airbus, and then for cash flow, after buying, they used to sell it to a third party, and from the same third party, they used to again get it back on lease. So when you are buying, again selling, and then taking it back on lease, how does the accounting work? Standard gives very clear guidance that in sale and leaseback transaction, you see whether there is a genuine sales or not. So to determine whether there is genuine sales or not, you apply Ind AS 115 principles. Ind AS 115 is on revenue recognition. So you see based on that 5-step model whether the control has been transferred to the third party or not. If the control is transferred to the third party, then you record this as a sales, you record the profit and loss on sale, and when you lease it back, you continue to measure the ROU at the same value. So ROU will be considered at the same carrying value just before the transaction of sale and leaseback happen, and the difference will be recognized in profit and loss. However, if it is not a sale as per 115 by applying those 5-step principle, then in nutshell, what you have done is you have just taken a financial help from the third party. In that means you don't record any profit and loss on the sale of transaction. Whatever consideration you have received by way of sale of aircraft, that will be regarded as a lease, as a loan, as a financial liability. So in financial, nothing will change. Sales will not be recorded, and the consideration received will be regarded as a financial liability or a loan. The next is on interest-free refundable security deposit. Many times, apart from lease payments, the transaction will also involve deposit being paid by the lessee to the lessor. How do you do this kind of accounting? So again, this accounting as such is not new for us. We have been applying principle of Ind AS 109, and we have been based on principle of Ind AS 109. If it's an interest-free deposit, or even if the rate is lower than the fair market interest rate, then we discount the value to arrive at the current net present value, and the difference is adjusted as a prepaid expenses. Now, for example, the lessee gives a deposit of rupees 1,000 for a period of 5 years, and the net present value of that 1,000 interest-free deposit is say 800 rupees. That 200 rupees is regarded as a prepaid rent and is amortized over a period of 5 years. Only change now is after 116, this 200 rupees, which is the difference between the deposit amount and the net present value amount, will be part of ROU. So whenever you apply Ind AS 116, on the transition day also it is important to create ROU, but apart from creating ROU based on future outflow, companies should also transfer this unamortized lease portion to ROU asset. That will be an important consideration. To the next slide, few other points which I want to highlight. I am now on slide number 44. Accounting treatment of rent equalization liability at the time of transition to Ind AS 116. Now, under earlier standard, there was a requirement that if there are step-up rental increases, so in initial year the rent expense is say 100, and it goes up by say 5% or 10% every year, then the company used to provide for straight lining, and that liability or asset would be regarded in will be reflected in the balance sheet. What do you do with these balances of rent equalization when you implement Ind AS 116 for the first time? ITFG, which was issued, ITFG Bulletin 21, which was issued last week, throws a light on this. It says whenever you are applying full retrospective approach, or whenever modified retrospective approach 1 is used, where the balance of difference between ROU and liability is adjusted in reserve. In both these cases, whether when it's a full retrospective or modified retrospective, under paragraph C8, C2, C8, C1, the difference will be adjusted in reserve. However, if modified approach 2 is used, which is defined in paragraph C8, C2, then the ROU balance will be adjusted. Second is presentation of ROU asset. We have already discussed that it will be part of tangible asset. Either you can show this as in the same table as furniture and ROU furniture, or you can altogether create a separate annexure only or separate table for ROU assets. Lease restoration liability. Whenever there is restoration liability, as per the agreement, those liabilities will be worked out and estimated on day 1, and that liability will be credited. The debit will now go to ROU. So till now, companies would be using property plant equipment and adding to the value of property plant equipment, or leasehold improvement, as the case may be. But now this restoration liability also would form part of ROU. The next point is on GST, which is not reimbursable. Now, generally, most of the industries will not face this issue, but this is an issue which is prevalent and very relevant for industries which are into restaurant business, or industry which is into oil and gas. In few of these industries, there is no GST reimbursement because the output liability is at subsidized rate. In that the question arises as to what should we do with the GST which is not reimbursable? Should it be forming part of ROU, or it should not form part of ROU? There are a lot of discussions and debate happening as to whether to include this as a part of ROU or not, but the final conclusion is GST which is not reimbursable should not form part of lease payment and should not be considered as a part of ROU. The logic behind that is GST is a tax which is charged by the government, and the lessor collects it on behalf of the government. It is not on a principal to principal basis. Whenever lessee collects, he collects as an agent of the government, and hence if the lessee pays 112 rupees, 100 is for using the underlying asset, 12 rupees is paid to the government. Only thing is it is routed through the lessor. Hence, this 12 rupees should not be considered as lease payment and should be charged off as and when the payments are made. So in this case, for the discounting purpose, you will not consider 112, you will consider only 100 for creating ROU. The balance 12 rupees will be charged off in profit and loss every year as part in the P&L account. The next point on deferred tax adjustment. So the entire lease accounting is only from accounting point of view. The tax balance sheet will continue to be as it is, because the tax authorities will not allow the deduction of interest and depreciation expenses, because the method there of depreciation is completely different. It will continue as per section 32. Hence, all these adjustments which you have discussed now so far will lead to differences under income tax, and hence companies should ensure that proper adjustments for deferred tax asset and liabilities are made with respect to this adjustment entries. Next question is on lease liability, borrowing and financial liability. I'll not spend time, we have already discussed. As of now, ICAI has not come out with any guidance, but it is expected that shortly it will come out on guidance on this particular aspect. The next topic is on lease modification. So lease modification, the standard gives guidance in paragraph 44 to 46. If you measure ROU and lease liability on day 1, assuming the expectation of the lessee to continue, and assuming the terms and conditions prevalent in that agreement. However, if the agreement changes, or if the intention of the lessor changes or lessee changes, then you modify and you do the revised calculation. The standard says if there is a termination or if there is a reduction in the period, then that difference you adjust ROU, you adjust liability, and the difference will be recorded in profit and loss only in case of reduction in the period. However, if there is extension of the period, then to that extent the difference will be adjusted in ROU. There is another concept of portfolio allocation. So paragraph B1 also gives a further relaxation. It says if there are multiple agreements of a similar nature, then company may not do accounting by applying the 116 based to individual agreement. It can club all the agreements and apply 116 on a portfolio basis. What does it mean? For example, a company which has many vehicles on hire. Now, generally, the vehicles are taken on rent basis for a period of say 5 years, 7 years, and 10 years, right? In that case, rather than making separate working for individual cars and trucks, company can merge all the vehicles with 5-year lease period, all the vehicles with 7-year lease period, and all the vehicles with 10-year lease period. And common working can be made for the purpose of ease. So that's paragraph B1, which is given in the guidance in the standard itself. The next is on impact of 116 with respect to compliance with related party. Very interesting. Many of us can miss this. Now, whenever related party transaction happens and approval takes place, for lease, it was always taken for 1 year rental expenses, generally what we pay. However, the commitment is for a longer term. But since in the books, it was reflected only for 1 year expense, the approvals were taken only for 1 year. However, this scenario changes. Now the commitment itself is for a longer period. So for example, if the agreement is for 5 years, then the commitment under the agreement is for 5 years. And second thing, you are creating ROU based on the 5-year lease payments by discounting it, and hence now all the more reason to get approval for the entire ROU balance rather than only the lease payment. So to that extent, the entire approval process of a related party transaction will undergo a change, and companies will have to be mindful whether they are within the limits under section 188. Next is on ICFR. From ICFR point of view also, companies will have to now involve finance team at the inception of the contract to see whether any contract entered into by the company covers any of the 116 principles. So if it contains lease, then the lease analysis has been done and the accounting has been recognized in the day one. So from ICFR point of view, some controls might undergo a change. And lastly, on inventory valuation also it will have some impact, because till now rent expenses were debited as a single item, and if it is a manufacturing expenses, for example rent of a factory or rent of a plant and equipment, the entire rent amount was considered as a part of inventory valuation. However, going forward, the rent expense will be bifurcated into depreciation separately and interest separately. Interest now being a financing expense, inventory valuation will undergo change, and finance expense will have to be excluded. So to that extent, there will be an impact on inventory valuation also. So these were few of the considerations I thought were useful and you should be considered. Lastly, I thought of showing you one presentation which is from the quarterly results of Jubilant Foodworks. Jubilant Foodworks, everyone knows, is running chain of restaurants under Domino's brand name. So being a listed company, they had already implemented in June 2019 results, and they've explained how and what choices they have made. So they have applied modified retrospective approach, or what is the impact in terms of creating ROU and liability is already given in the note. And more interestingly, everyone should look at the table appearing now in the slide, where they had given, had it not been 116, had it continued the same accounting policy, how the rental expense, other expense and depreciation would have been, and because of change in the standard due to implementation of 116, how it is changing. And the third column is how the derived figure, which is actually the results which are appearing in the quarterly results. So very well drafted note. If the impact is big, significant on your clients or in your company, definitely someone should look at this kind of presentation, because that will show true intent and a clear comparison is visible. I'll leave this slide open for 2 minutes for everyone to see it, and I can cover up the questions. Yeah. So, first question was, what should be the rate taken for working out present value of lease obligation? We have discussed that discount rate will be the rate which is implicit in the agreement, lease agreement. However, if the rate is not implicit in the agreement, then it will be the incremental borrowing rate of the lessee. So incremental borrowing rate means the rate at which the loan can be availed by the lessee. Second question is, if on transition date period remaining to original 48-month lease is only 3 months, can this exemption be availed? Short-term lease exemption, okay. So here the answer is, if you are going by modified retrospective approach, then yes, even though the original agreement is for 48 months and on the transition date the period is less than 12 months, then you can apply short-term lease exemption, provided you are going by modified retrospective approach. Again, in modified retrospective approach, you can go for option 1 or option 2, that is irrelevant. However, if you are going for full retrospective approach, then you will have to comply with the standard, even though the remaining period is only 3 months. Is mentioning of units compulsory for specified asset, or mentioning amount is enough for any specific commodity? Example, gold is being leased. Mentioning of amount is. So if from disclosure point of view, units are not required to be given. For the purpose of calculation, amount will be considered for the purpose of calculation. If I've understood your question correctly, if I'm not answered you properly, maybe you can get in touch with me after this webinar. Another question is, if I have taken a part of an immovable machine on lease and that part is being used by the lessor, then what will be the effect? No, if you have taken an immovable machine on lease, then lessor cannot use. You know, if you have taken as a lessee and the lessor still continues to use, then maybe you don't need to consider whether it is a lease or not. What if the lease is cancelable by third party other than the lessee and the lessor? For example, government, will it affect the lease? So, this scenario will come in a remote cases. Generally, the cancelable has to be agreed between both the parties, the lessor and the lessee. Government may come out with a rule, and you will not factor that in the inception. If that happens, that will be a modification of lease, and you will do accounting as per the modification. In full retrospective, in third year, balance sheet needs to be given, or only previous year is to be restated. So yeah, 3-year P&L will be given. All the adjustments will be given in the opening reserves. In case of a land lease, whether the rental paid to the lessor is based on the consideration earned by the lessee based on the lessee's usage of land, would it be considered as a lease? In case of a land lease, whether the rental paid
Dependency of lease rent based on the earnings.
Variable rent.
Variable.
Okay, so again, good question. Let me actually also bring to the relevant topic. In case of land and building hired in a single transaction, I've covered in my presentation somewhere, but I didn't probably cover it while speaking. So whenever there is a agreement, under a single agreement, you have covered land and building. Land and building both are separate lease component, and both will be regarded or considered separately from ROU creation point of view. So land ROU would be separate asset, and building ROU also will be a separate asset. Now, that is more relevant because the life of building would be a finite life, whereas the land would be indefinite life. So from amortization point of view, that's very important. Even if the agreement does not give values separately, you need to do a fair valuation exercise and arrive at the values separately. Now, if the rental is based on the variable lease payment, for example, based on the rent, based on the sales, then that will be excluded while creating ROU. ROU will be created only if there is a fixed portion. If there is a variable portion will be debited to profit and loss in the year in which it is incurred. What if the agreement states that the lease amount rupees 5,000 but have to be paid rupees 4,500 only because the lessee is paying rupees 500 property tax on behalf of the owner? 500 is not a component of the lease payment. Yeah, so that we have covered. In that case, you don't segregate. We have to segregate only non-lease payment and lease payments. Payments which are not component is always part of the agreement itself. Will variable lease payment LIBOR mentioning affect my discount rate percentage? So variable lease payments which are linked to the discount rates or to the LIBORs are actually considered for lease payment. Now, whenever there is a change, so you will assume the current LIBOR rate and arrive at the ROU. If the LIBOR rate changes subsequently in future, you will remeasure both liability as well as ROU, and every year you will do this adjustment in the balance sheet. So your ROU and liability will keep on changing based on the underlying changes. If I have given a contract of manufacturing and isolation of an asset on the condition that the ownership of the asset will lie with the contractor till the end of installation, and till then I will pay him some part of the revenue as a consideration, then will it be treated as lease? So I think the question is, the machine is taken on lease and till the installation the machine will continue. However, some part of the revenue also will be paid as consideration. Now that means there is a variable consideration. To the extent the consideration is variable, it will be excluded from the calculation. Whatever consideration is fixed, that will be considered for the calculation of ROU. The variable consideration will be expensed out as and when incurred. In case of NBFC, 50% is not allowed as GST credit and expensed out. So in that case, GST to be adjusted to ROU or not. So agreed. So to that extent of 50% GST credit, which is not reimbursable, will not be considered in part of ROU, and it will be expensed out as and when the payments are made. So that's it. Thank you everyone for listening for this last 2 hours. It was really encouraging for me also for all of you to attend this in spite of this very busy season. And I thank Anil for giving me this opportunity. Thanks, Anil.
Yeah, thank you, Hemal. We basically, friends, Hemal must have, you must have seen in last 2 hours that Hemal has taken us through the entire 116 provision with all integrities, which is actually required for practical application. At the same time, he has also, answered most of the questions which has been raised through online thing. Now, on behalf of the entire team of Chamber, we propose a hearty vote of thanks to him, and we we request all of you to have in your respective offices. Thank you.
Thanks.